Welcome back to our channel. Today we are diving into essential topic in international trade and finance, demand guarantees and standby letter of credit. These financial instruments play a critical role in protecting businesses from risk associated with complex contracts, especially across borders. Let's start with the basics. Demand guarantees and standby letter of credits are tools banks provide to support corporate clients. Think of them as a security promises made to cover potential risk of non-performance or non-payment in a contract. They are widely used in sectors like trade, construction, finance, manufacturing, shipbuilding, and more. These guarantees serve as a safety net, assuming that if one party doesn't fulfill its contract obligation, the other party won't face financial losses. As we have earlier discussed, demand guarantees and standby letters of credits are useful tools for bank to support its corporate customers. To recap, demand guarantees and standby letters of credits are commonly used in international trade, construction projects, finance, insurance, manufacturing, shipbuilding, and aircraft leasing. But they can also be used in many other types of businesses. Whether two parties enter into an agreement, one party may want a guarantee that the other party will perform its obligation or pay any amount which may due under the terms of the agreement. Rather than require a deposit of cash to cover the risk of non-performance or non-payment, the parties may agree that one party, which is known as an applicant, will instruct its bank to issue a demand guarantee or standby letter of credit in favor of the other party, who is known as the beneficiary. The demand guarantee or standby letter of credit therefore cover the risk of default by the applicant. Types of demand guarantees. Demand guarantees vary based on the risk they cover and who is involved. Let's quickly go over some of the most common type. First one is payment guarantee, which protects against non-payment of goods or services. Second, performance guarantee, which is also known as performance bond, which covers non-performance of contract, which is common in construction or supply. Third, advance payment guarantee, which ensures repayment of any advance if the contract is not completed. Fourth, retention money guarantee, which is often used to release final payment to the contractor upon completion, covering potential warranty breaches. Fifth one, warranty guarantee, similar to retention guarantee, covering specific warranty obligation in this contract. Sixth, customs guarantee, which covers duties if goods are not re-exported within a specific period. Tender guarantee or bid bond is the seventh one, which is used in bidding processes ensure serious intent from the bidder. Eighth, subcontract guarantee, which covers payment and performance within subcontracts. Ninth, court or arbitration guarantee, which ensures payment of any court awarded damages or legal cost. 10th, financial guarantee, which covers obligation in banking or insurance agreements. 11th one, parent company guarantee. A company's assurance of its subsidiaries' obligation is known as parent company guarantee. Let's discuss them in detail. Payment guarantee. These are one of the main categories of demand guarantees. They cover not only the risk of default in payment of goods and services, but also risk of non-payment in many other commercial relationships. Performance guarantees are also called performance bond and cover the obligation of the party to perform the contract. Advance payment guarantee. In the event of non-fulfillment of the contract, the supplier does not repay the buyer any advance payment made by the buyer. Note that advance payment guarantee operate in reverse to payment guarantees. They cover the repayment of sums already paid. In some industries, such as shipbuilding industry, an advance payment guarantee is often called a refund guarantee. So So advance payment guarantees are also known as refund guarantee. The problem that often arises with the advance payment guarantees is that the party making the advance payment does not want to make the payment until the guarantee has been issued by the receiving party's bank. However, the receiving party does not want the paying party to be able to claim on the guarantee unless the advance payment has been made. The usual solution for the guarantee to be issued before the payment is made, but the guarantee will include a clause which states that no demand can be made unless the guarantor first receives evidence that the advance payment has been made. If the contractor is entitled to payment in stages, an advance payment guarantee may also include a provision for the value of the guarantee to be reduced against presentation in documentary form of confirmation that part of the advance payment has been earned at each stage. In simple terms, an advance payment guarantee is a financial instrument that protects the buyer or the party making an upfront payment in case the supplier or contractor does not fulfill the contract. Essentially, it ensures that if the contract terms are met, the buyer can recover the money they paid in advance. For example, in shipbuilding, this is often referred to as a refund guarantee because it helps the buyer to get refund of their advance payment if the shipbuilder does not complete the project. How is it different from a payment guarantee? It is crucial to understand that an advance payment guarantee works in the opposite way to payment guarantee. Instead of ensuring the supplier gets paid, it covers the repayment of sums already paid by the buyer. So, while a payment guarantee is all about securing a supplier's payment, an advance payment guarantee protects the buyer's upfront investment. A common issue with advance payment guarantee is timing. Here is why. A buyer wants the advance payment guarantee to be issued by the supplier's bank before making the payment to ensure their money is protected. On the other hand, the supplier does not want the buyer to able to claim on the guarantee until they actually receive the advance payment. To address this timing issue, a typical solution is to issue the advance payment guarantee before the payment is made, but include a clause stating that the guarantee only becomes valid once proof of the advance payment is provided. This way, the buyer's investment is secure, but the supplier is also protected from premature claims. For example, the guarantee might say no demand for repayment can be made unless the guarantor first receives evidence of the advance payment. This conditional structure helps keep things fair and balanced for both parties. In some contracts, the supplier or contractor may receive payments in stages as work progresses. In such cases, an advance payment guarantee can also have a provision to reduce its value over time. Here is how it works. The guarantee's value decreases each time the supplier completes a stage of work and provides documented proof of it. This approach allows the guarantee to reflect the actual remaining risk as the contract is fulfilled, protecting the buyer's interest without unnecessarily burdening the supplier. So, that's a breakdown of how advance payment guarantees work. They are crucial for securing advance payment in high-value projects, providing peace of mind for buyers and protecting suppliers through carefully structured clauses. Now let's see what is an retention money guarantee. Retention money guarantees allow for the release of full price to the applicant, that is, the supplier or contractor, upon delivery of goods or completion of the project. If a customer did not have benefit of the retention money guarantee, the customer would be entitled to retain part of the price, for example, 5% as security for potential breach of representation or warranties given in the contract. Now let's see what is warranty guarantee. Warranty guarantees cover the risk of breach of warranty in respect of goods, works or services delivered by the applicant. A warranty guarantee therefore covers much the same obligation as retention money guarantee, but they work different ways. The value of the retention money guarantee is part of the contract price, which is to be repaid to the customer if there is a default by the contractor on the representation of the warranties. The value of the warranty guarantee is an estimate of the compensation required by the customer if there is a default by the contractor. The full price is payable in any event. Now let's see them in more detail. Let's start with retention money guarantee. This type of guarantee allows a supplier or contractor to receive the full payment for the project or goods delivered once the work is complete. Here is how it works. Without a retention money guarantee, the customer would typically hold back a small portion of the payment, say 5% of the contract price as security. This retained amount acts as a buffer for the customer in case of any breaches of contract or defect that need to be fixed. However, with the retention money guarantee in place, the full payment is released to the contractor upon project completion. The retention money guarantee then provides security to the customer, covering potential breaches of warranty or defects without holding back any payment. This setup benefits both parties. The contractor receives their payment in full, and the customer still have a safeguard for any unexpected issues. Understanding warranty guarantees. Now let's move to warranty guarantees. This type of guarantee is specifically designed to cover breaches of warranty for the goods, works, or services provided by the contractor. If something goes wrong with the goods, if the project does not meet agreed standards, the warranty guarantee provides the customer with compensation. Here is the difference. With a warranty guarantee, the full price is paid to the contractor regardless of any issues. If a breach of warranty arises, the warranty guarantee can cover the cost of repairs, replacement, or any necessary compensation for the customer. In short, the retention money guarantee is part of the contract price held back as security, while warranty guarantee is a separate amount estimated to cover potential issues that could arise. Key differences between retention money and warranty guarantee. Let's take a closer look at what sets these two guarantees apart. Retention money guarantee is tied directly to the contract price. It ensures that a portion of the total price can be repaid to the customer if the contractor fails to meet the agreed standard of warranties. Unlike the retention money guarantee, the warranty guarantee is not directly part of the contract price. Instead, it represents an additional estimated amount to cover any future compensation for defects or breaches. This means that with retention money guarantee, payment to the contractor is only partially withheld. But with warranty guarantee, the contractor receives the full price and the warranty guarantee is there to provide security. When to use each guarantees? When should each of these guarantees to be used? Retention money guarantee is often used when the customer wants to pay the contractor in full but still needs some security. It's particularly common in industries where quality checks and defect-free completion are essential, like construction. Warranty guarantee is ideal for contract with focus on ongoing warranty coverages after the project is complete, such as when product or services need to meet a high standard over time. The warranty guarantee gives the customer peace of mind that if anything goes wrong, they are covered for necessary compensation. In summary, retention money guarantee and warranty guarantees are both essential tools in project financing and trade. They help secure payment, quality, and compliance with the contract teams, each in their own way. Understanding the distinction between these guarantees can help you choose the right retention for your contract, whether you are a buyer booking a secure quality or a contractor wanting to ensure full payment. Now let's see what is a custom guarantee. Customs guarantees are issued to customs authority to cover any duty or liability that may become payable when goods or equipment imported into a country on a temporary basis are not re-exported within an agreed time period. Now, what is tender guarantees? Tender guarantees are also called bid bonds, and they cover risk of failure by the successful bidder to conclude a contract. This guarantee discourages the bidder from withdrawing its bid before the customer makes a decision on awarding the contract. It also deters the bidder, if awarded the contract, from refusing to sign the contract according to the terms proposed by the customer. Now let's see what's a subcontract guarantee. These are a form of normal demand guarantee issued in association with large projects. They can work in several ways. The first type of subcontract guarantee is a payment guarantee covering the obligation of the main contractor, who is known as an applicant, to pay the subcontract, which is beneficiary in this case, for the works performed by the beneficiary. The second type of subcontract guarantee is a performance guarantee or a warranty guarantee or an advance payment guarantee in favor of the main contractor to secure the performance of obligation of the subcontractor under the subcontract. Here, main contractor is beneficiary and subcontractor is applicant. Sometimes, the main contractor may wish to transfer such subcontract guarantee to ultimate project owner instead of reissuing new guarantees in favor of the owner. However, guarantors are sometimes reluctant to allow a transfer to the project owner, since the owner is not a party to the subcontract and may not be able to give an accurate statement of breach by the subcontractor. Indeed, the requirement for the transfer under URD 758 Sub-Article 33D effectively prohibits such transfer. This sub-article would have to be excluded or amended in a demand guarantee subject to URDG 758 before such transfer of the project owner could proceed. Financial guarantees. In various sectors of finance industry such as banking and insurance, demand guarantees can be used to secure the obligation of one party that may be called upon to make a payment in relation to an underlying agreement. What's a parent company guarantee? Parent company guarantees may be issued by a parent company to cover either the performance or the payment obligation of its subsidiary or affiliated company. The beneficiary is often the counterparty of the underlying contract. A parent company may also issue a guarantee in favor of the bank that has agreed to issue a demand guarantee in favor of the counterparty to the underlying contract. A parent company guarantee issued as a demand guarantee is a normal demand guarantee. It is in a similar form to the other guarantees we have discussed earlier, but the difference being that the guarantor is a parent company rather than a bank. However, in some countries it is prohibited for any company other than a bank to issue a demand guarantee. In those countries, parent company guarantees are usually issued in the form of suretyship guarantee. In short, the list covers the main type of demand guarantees, but in practice there is no limit to use of demand guarantees in commercial transactions. They can provide cover for any commercial obligations in any sector of industry or trade. However, it is important to note that demand guarantees are rarely used in consumer transactions. In some countries, a demand guarantee in a consumer transaction may not be legally enforceable. Standby letter of credits versus demand guarantees. With so many types of demand guarantees, you might wonder, when should I use a standby letter of credit? While there is no strict rule, but here is a general guidelines. Standby letter of credit are commonly used in North America, often preferred for payment obligations. Demand guarantees are widely used in Europe and they are generally chosen for performance obligations. The choice often depends on the regional practice and the bank's preference. All the type of demand guarantees which we have discussed are also applied to standby letters of credit. Again, there is no limit on use of standby letters of credit in commercial transactions, but it would be unusual to find one used in consumer transactions. Some banks will commonly issue both demand guarantee and standby letters of credit. The choice will be the banks to agree with the customer. There is no fixed pattern of this choice, but one possible approach is to use standby letter of credit as a payment obligation and demand guarantees for performance obligations. There is no right or wrong answer to the question if the instrument is carefully drafted and suitable rules are incorporated. The instrument should work as an independent undertaking, providing the beneficiary with adequate security. In summary, the risk of defaulting payment in almost any transaction can be covered by the demand guarantee or standby letters of credit. However, there are some transactions for which having a demand guarantee or standby letters of credit issued by the applicant's bank does not provide sufficient protection for the beneficiary, particularly where the beneficiary is in a different country to the guarantor or issuing bank. The beneficiary may decide that it wants additional protection from the local bank, and in this stage, the solution may vary to arrange a counter guarantee or a confirmed standby letter of credit. Counter guarantees and confirmed standby letters of credit. For extra protection, especially in cross-border deals, you might see counter guarantees and confirmed standby letters of credit. In a counter guarantee, one bank issues a guarantee to a second bank, which then issues a final guarantee to the beneficiary. Each guarantee can have its own terms and legal jurisdiction. Here, an issuing bank gives an undertaking to the beneficiary, and the confirming bank reinforces it, which providing an additional security. For the confirmed standby letter of credit, there is only one single instrument. The issuing bank gives an undertaking to the beneficiary on the terms of the standby, but the standby is then confirmed by a confirming bank in favor of the beneficiary. The terms of the confirming bank's obligation to the beneficiary are identical to the issuing bank's obligation to the beneficiary. In contrast, the demand guarantee and counter guarantee are two separate instruments. The counter guarantee is issued by the counter guarantor in favor of the guarantor, and the demand guarantee is then issued by the guarantor in favor of the beneficiary. The demand guarantee and counter guarantee may have different terms and can be subject to different laws and legal jurisdiction. In normal circumstances, the beneficiary will present the demand guarantee to the guarantor, who will then check that the demand complies with the terms of the demand guarantee. If it does comply, the guarantor will pay to the beneficiary. However, the guarantor has no automatic right to reimburse the counter guarantor. Instead, the guarantor must present a demand under the counter guarantee, which complies with the terms of the counter guarantee. There is a further difference between these two instruments. In the event that the confirming bank defaults and fails to pay a complying demand, the beneficiary of the standby letter of credit has the right to present the demand direct to the issuing bank and to be paid by the issuing bank. However, if guarantor defaults, the beneficiary of the demand guarantee has no right to present demand direct to the counter guarantor. Counter guarantees and confirmed standby letter of credit in practice. Let's see these instruments in action in a hypothetical scenario. Imagine a company, let's call them MC, which wins a contract in a foreign country. The local authority wants a performance guarantee. However, MC's bank does not have branches in the project's country, and the authority is cautious about legal challenges. So, MC's bank partners with a local bank to issue the guarantee. Here, they have two options. First one, use a confirmed standby letter of credit. The foreign bank issues the standby letter of credit confirmed by the local bank. This allows the authority to claim directly from the local bank or MC's bank if the local bank defaults. Second, use a counter guarantee. The foreign bank issues a counter guarantee to the local bank, which then issues a demand guarantee to the authority. These setups include two instruments with separate terms, giving flexibility but with a bit more complexity. So, our final concept is asymmetrical counter guarantees. These offer flexibility if the beneficiary's required terms differ from what a counter guarantor's bank prefer. However, this could mean the local bank faces increased risk as they might need to pay a claim without reimbursement. As we know, a counter-guarantee structure can provide greater flexibility than a confirmed standby letter of credit, where the terms required by the beneficiary differ from the terms which the counter-guarantor bank is willing to issue. The differences between the counter-guarantee and the demand guarantee may relate to the terms of the instrument, the applicable law, or the applicable rules. Before agreeing to issue demand guarantee supported by an asymmetrical counter guarantee, the local bank should consider carefully whether it is prepared to accept the risk of having to pay a claim under a demand guarantee without being able to recover under the counter guarantee. Therefore, from the point of view of the local bank, the closer the counter guarantee matches the guarantee, the smaller the risk of the exposure. For example, the local bank may insist that the applicable law and jurisdiction provisions in both the demand guarantee and the counter guarantee should be the same. In summary, demand guarantees and standby letters of credit provide crucial security in high-stakes transactions. Whether it's payment, performance, or cross-border complexities, these instruments can offer tailored protection to business needs. That's the end of this section. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and drop any questions you have in the comments below. I will see you in the next video.